I'm 680 News Senior Business Editor Mike Eppel. We wrapped up the quarterly earnings season for the big Canadian banks today, and all in all, 2018 was a stellar year when it comes to profitability. The Bank of Montreal was the last to report its fourth quarter and full year earnings. On a per-share basis, and net profit for the fourth quarter, earnings up almost 38% at the BMO, helped out by its U.S. banking operations, again with Trump tax cuts still filtering through to U.S. corporations, or their U.S. earnings at least. For the full year, Bank of Montreal made $5.4 billion, and that put it in fourth place overall for the Big Five. The biggest of the bunch, Royal Bank, made $12.5 billion, a record 2018. Collectively, the big banks made $43 billion in net earnings for 2018. Unintended consequences, perhaps, from the Alberta government's move in the energy market announced over the weekend. That plan by the Notley government to mandate a production cutback for Canadian energy output starting in the new year. Some think that government intervention isn't that good of a thing for the marketplace and could lead to foreign investor chill. Having said that, others think it was the right thing to do, to try to stabilize the market for the next little while and alleviate the pipeline constraints. Tim Pickering, the chief investment officer at Auspice Capital, says Canada, really, when you look at it, is one of the few countries that actually doesn't make some substantial moves, at least not until now, in the energy trade.
Even in a free market like the United States, they have the ability to control it through the SPR, the Strategic Petroleum Reserve, and they have significant export capabilities. So Canada is just playing catch-up in a way. So I think that this intervention, while essentially a manipulation by a government, shouldn't be a big surprise to people. It was necessary, and where there's a systemic or structural flaw in a free market.
Price for oil today, incidentally, was little changed when all was said and done as we await an OPEC meeting coming up on Thursday. Well, we can expect to pay more for fresh fruits and vegetables next year. The Canada Food Price Report was in today from the University of Guelph and Dalhousie University, and they are predicting that vegetable prices specifically will be on the rise in 2019, going up by 4 to 6%. The reason? Well, Canadians are trying to eat healthier. There's less or more demand for fresh fruits and vegetables and less supply due to climate change, smaller crops so far for 2018. And 2019 is going to be an El Nino year, and that's going to lead to more weather volatility. Meantime, for the first time in 9 years, meat and seafood prices are expected to fall. Overall, Canadian family budgets can price in a $400 increase in the average food bill for a family of four, going up to just above $12,000 for the year. Canadian cannabis company Aphria of Leamington, Ontario, saw its stock price plunge for a second day. The company's been hit by short-selling allegations. An investment firm out of the U.S. questioning Aphria's investment in cannabis companies in Latin America says that they paid way too much for what they got. The company, Aphria, issued a statement today saying, indeed, it's looked overview of Latin America and is very positive on its forecast, but didn't help the stock price at all today for Aphria, which has seen its stock price fall more than 40% in the first two trading days of this week on Bay Street. And the Canadian dollar today was down, holding just below 76 cents U.S. We're going to get a decision on interest rates tomorrow from the Bank of Canada. And no change expected in the overnight lending rate for the Bank of Canada to hold off on raising interest rates again into the early stages of next year. From the 680 Newsroom, I'm Mike Eppel for City News.